Welcome back to Smart Stock Sam, the channel where we cut through the noise, read between the lines, and find the real trade hiding behind every headline. We are a community built on data, discipline, and the kind of honest, unfiltered analysis that actually helps you make better decisions with your money. If you are new here, hit that subscribe button right now, because today's breakdown is exactly the kind of deep dive analysis we live for on this channel. And trust me, you do not want to miss a single minute of what we have built today. Now, let me ask you something. What if I told you that a company just delivered the most jaw-dropping earnings quarter in semiconductor history? $81.6 billion in revenue in a single quarter. Authorized an $80 billion share buyback program, raised its dividend by 25 times over, and the market still punished the stock nearly 7% in a single week. You would probably say that makes absolutely zero sense, and you would be right to be confused. But here is the thing. That confusion, that gap between what the numbers say and what the price is doing, is exactly where the real opportunity hides for investors who are willing to look past the surface. Here is your upfront roadmap for today. We are going to start by breaking down why a historically perfect earnings report still sent the stock bleeding lower. Then, we will explore the massive new revenue frontier Nvidia is quietly building, one that could redefine the company entirely. We will hit the single most important catalyst event of the week, the one binary trigger that could flip this whole narrative overnight. Then, we will dissect what the institutional data and options chain are telling us that the mainstream media completely missed. We will walk through the technical landscape, identify every key level that matters, and then hand you a complete, ready-to-execute trade blueprint. All of that, right here, right now. Let us get into it. So let us start with the question on every investor's mind this week. Why on earth would a stock fall nearly 7% after reporting the greatest single quarter in its company's history? The answer is a concept every serious trader needs to understand cold. Buy the rumor, sell the news. The market had already priced in a flawless print. Wall Street had modeled perfection into the stock price weeks before that earnings call ever happened. So when the results came in exactly as expected, even spectacularly so, there was simply no room left for the price to run higher in the short term. Compound that with the market beginning to digest $7.6 billion in quarterly operating expenses, layer on ongoing macro anxiety around interest rate policy, and you get a measured, calculated drift lower. The stock fell from its all-time high of $236.54 down into the low 200s. But here is what that narrative misses entirely. The market is not saying Nvidia is broken. It is saying the stock needs a moment to breathe before the next leg higher. And breathe it will, especially when you understand what is coming next. Because Nvidia is not the company most people think it is anymore. Yes, they built the GPU moat that powers the entire artificial intelligence revolution. But right now, they are actively escaping that moat and building something far larger. Enter the Vera CPU, a processor built from the ground up for agentic artificial intelligence workloads. We are not talking about running a chatbot. We are talking about autonomous AI agents making real-time decisions across complex enterprise systems. And the total addressable market for that kind of processing power? $200 billion. That is a market Nvidia barely touched 12 months ago. What makes this truly exciting is that execution has already begun. The early standalone revenue run rate on Vera CPU technology is already tracking at $20 billion, with deployments running live at some of the most powerful organizations on the planet: OpenAI, Anthropic, Oracle Cloud, and SpaceX. Think about that for a second. The companies building the future are already running Nvidia's next-generation architecture. The market is not pricing that in yet, and when it does, the current level will look like a gift. But here is where things get even more interesting. And this is the part that almost nobody in the financial media is talking about. There is a date circled on every serious institutional calendar this week, and that date is June 1st. Nvidia CEO Jensen Huang is taking the stage at the Computex keynote, and Wall Street is treating this as a genuine binary risk event. Think about what that means. A single keynote presentation could swing this stock significantly in either direction within hours. What are people expecting? A coordinated teaser campaign from Nvidia, Microsoft, and ARM has been building buzz around the phrase, "a new era of the PC." The specific products anticipated are the N1 and N1X ARM-based laptop processors, and if those land the way analysts expect, they represent a direct, aggressive challenge to Intel and AMD's decades-long dominance over the Windows PC ecosystem. This is not a product launch. This is a declaration of market war. If Jensen walks off that stage having delivered, the narrative around Nvidia flips from digesting earnings to entering a new chapter of growth, almost instantly. Could this keynote flop entirely? Statistically, the odds are slim. But that exact uncertainty is what makes the setup so compelling right now. Now, before we talk about what the charts are saying, let us look at what the real institutional money is actually doing, because this is where the story gets genuinely fascinating. When retail panics, institutions accumulate. It sounds like a cliché, but the data right now is almost startling in how clearly it shows that pattern playing out. 76.7% of Nvidia's entire float, that is 18.57 billion shares, is currently locked up in institutional ownership. These are pension funds, endowments, sovereign wealth funds, and major asset managers who hold through noise like this without flinching. We also saw Danica Pension aggressively expand their position, making Nvidia their single largest holding at $523 million. There was even notable insider buying disclosed earlier this year. The only selling on record? A completely negligible 625 shares trimmed by one board director. When you see that kind of institutional conviction during a pullback, you pay attention, and the valuation picture reinforces exactly why they are holding. Here is a number that should make you stop and think. Nvidia is currently trading at a forward price-to-earnings ratio of 26.2 times. The broader semiconductor industry median sits at roughly 34 times. Nvidia, the dominant artificial intelligence infrastructure company on the planet, is trading at a discount to its own sector. The core argument that Nvidia is wildly overvalued is mathematically losing ground fast. If the company captures even 10% of that new $200 billion Vera CPU market, 26.2 times earnings becomes severely undervalued almost overnight. This is why the analyst consensus price target currently sits at $303.27, representing roughly 40% upside from current levels, with firms like Truist and Needham reiterating strong buy ratings even after this week's drop. But here is the honest truth, and this is where Smart Stock Sam always keeps it real with you. The fundamentals can look incredible, and the stock can still fall further in the short term. And right now, the technical picture is demanding serious respect and serious caution. From a pure technical standpoint, the aggregate signal is a strong sell. The stock has broken below its 5, 10, 20, 50, and 100-day moving averages. It has decisively cracked through the first support pivot at $215.52. The single most critical line remaining is the 200-day moving average, sitting at $212.57. If buyers fail to defend this line convincingly, the next stops are a structural support zone near $204.50, and then the major psychological magnet at $200 flat. The momentum indicators confirm the bearish short-term picture. The MACD has printed a bearish crossover, currently sitting at negative 0.460. The relative strength index is at 39.98, approaching oversold territory, but not yet there. We have not hit the sub-30 reading that would signal true panic capitulation. And that matters enormously because it tells us something very specific. This is not a fear-driven retail stampede for the exits. This is a methodical, algorithmic grind lower, a controlled, engineered process. The machines are running the show right now, and they are doing it patiently, which brings us to the single most powerful invisible force controlling Nvidia's price right now, and one that most retail investors have absolutely no idea even exists. Welcome to the $210 Gamma Pin. This is one of the most important concepts in short-term options-driven price action, and understanding it will completely change the way you read a chart like this one. If you have ever watched Nvidia's price and wondered why it feels like it is stuck in quicksand, here is your answer. Look at the options chain. Market makers are holding this price hostage between two enormous walls of contracts. There is massive overhead friction with over 10,000 call contracts stacked at the $215 strike. Below the current price, there is a hard defensive floor of put contracts concentrated at the $200 strike, and sitting right in the middle, acting as a gravitational magnet, is the $210 strike, where call and put open interest overlaps so heavily that it pulls the price toward it like a black hole. If the stock breaks decisively below $210, market makers will be forced to unhedge their positions, which could trigger a rapid, violent vacuum drop straight down to that $200 put support wall. This is not speculation. This is mechanics. Now, some people watching this are probably thinking, massive short interest, big drop, sounds like a short squeeze setup, and I need to address that directly because it is a dangerous idea. The short interest on Nvidia right now is 1.28% of the float. The stock borrow fee is practically zero at 0.25%. There is no squeeze fuel here whatsoever. What the data does show is an elevated off-exchange dark pool short volume ratio at 42.56%, which tells us this is institutional hedging and valuation rotation, not an aggressive directional short attack. This is a managed process, not a panic, and managed processes have predictable resolution zones. So what does the actual trade look like heading into this week? Here is your blueprint. The overall bias for the June 1st through 5th window is neutral to mildly bullish, meaning we are looking to buy the dip strategically, not chase strength blindly. There are two entry paths depending on your risk tolerance. Path 1 is the conservative breakout entry. You wait for a 4-hour candle to close above $215.50 to $216. Why? Because that proves the market has cleared the overhead options resistance and is responding positively to the Computex catalyst. You are paying a little more, but you have technical confirmation on your side. Path 2 is the aggressive dip buy entry. You place limit orders at $206.80. That level gets you inside the structural support zone, beneath the $210 options magnet, and safely ahead of any stop hunt sweep that will inevitably happen at the $200 psychological level. That $200 level is where algorithms love to grab retail stop losses before reversing hard in the opposite direction. And getting in at $206.80 means you are already positioned when that reversal kicks in, not chasing it after the fact. Patience on entry is what separates profitable trades from frustrating ones, and this is a perfect example of why. Both of these entries have clear logic behind them, and both serve different investor personalities. The conservative entry gives you confirmation at the cost of a slightly higher price. The aggressive entry gives you a better risk-to-reward ratio at the cost of sitting through more potential short-term turbulence before the resolution arrives. Know which type of trader you are before you place the order. Regardless of which path you choose, your hard stop loss is a daily close below $196.80. If that level breaks on a daily close, the entire post-earnings technical structure is invalidated, and the trade thesis needs to be completely reassessed. Protect your capital first, always. On the upside, if the Computex keynote lands and the $210 level holds through the week, the immediate short-term rebound target is $225. Beyond that, as the Vera CPU revenue begins to formally hit the books in the third quarter of 2026, the midterm target range sits between $280 and $303. The long road back to all-time highs and beyond is absolutely on the table. Just respect the process and respect the levels along the way. Before we wrap up, I want to be completely transparent with you, because that is what Smart Stock Sam is built on. Everything discussed in this video is purely for educational and informational purposes only. Nothing here constitutes financial advice, and nothing here should be treated as a recommendation to buy, sell, or hold any security. Markets are inherently unpredictable, and all trading and investing carries real risk, including the risk of losing your entire investment. Always do your own research, consult with a licensed financial professional before making any investment decisions, and never trade money you cannot afford to lose. The analysis presented here reflects publicly available data and technical frameworks. It is a starting point for your own thinking, not a substitute for it. All right, Smart Stock Sam fam, let us bring it home. The bottom line on Nvidia right now is this. We are watching expected, healthy valuation digestion after an historic earnings print, not a fundamental collapse. The institutional money is holding the line and adding to positions on weakness. The Vera CPU is opening a $200 billion new frontier that the market has not fully priced in yet. The Computex keynote is a genuine binary catalyst that could flip the entire narrative this week in a single session. And the $204 to $208 zone remains the strategic decision point for anyone looking to optimize their risk-to-reward entry right now. Trade the levels, respect your stops, trust the data over the noise. And remember, while everyone else is panicking at the red numbers in their portfolio, the smart money is already quietly positioned and waiting for the next move to unfold. Now, I want to hear from you. Here is my question for the comments this week. If Jensen Huang delivers a massive N1X reveal at Computex and the stock gaps up 5% in a single session, do you buy the gap or do you wait for the inevitable pullback? Drop your answer below. I read every single comment, and I genuinely want to know how you are thinking about this trade. If this breakdown gave you clarity and confidence today, do me a favor. Hit that like button. It takes 2 seconds, and it means the world for helping this channel reach more investors who need this kind of analysis. And if you are not subscribed yet, what are you waiting for? Hit subscribe right now so you never miss a breakdown like this one. We post every single week, and if you really want to support what we are building here at Smart Stock Sam, you can send a super thanks using YouTube's support feature right below this video. Every single contribution goes directly back into making this content better, deeper, and more valuable for this entire community. I see every one of them, and I appreciate each of you more than you know. Until next update, stay sharp, stay disciplined, and keep building. This is Smart Stock Sam, and I will see you in the next update.